So the trifecta is coming. If you don't know what a trifecta is, I learned when I went to the Kentucky Derby. That's when you picked each horse in exact order, first, second, and third. So horse number 1, consumers will continue to be more conservative with their spending. So here's what I want you to focus on. Even a small downturn in consumer spending damages the economy. That's not what the government wants. As it drops off, economic growth slows. Prices drop, and this creates deflation. If slow consumer spending continues, the economy actually contracts. This is exactly what's been happening with the 11 rate increases. And of course, we all know commercial real estate is in a deflationary period. So some of the causes of deflation are decrease in demand. The fall in demand of goods and services triggers a decline in the prices of goods and services, which causes deflation in the economy. That's what we're starting to see now. Just a note here, this was the strategy of the Federal Reserve. When inflation hit over 9%, they freaked out and they've raised rates over 11 times since that period. But here's why I think it's really a problem, because we're now heading toward a credit card nation. In 2 years, we went from record savings to record debt, and if that's not a red flag, I don't know what is. So this chart represents personal savings rate and goes all the way back to 1960. So we have 60 years of history, and hopefully you can see that at 3.5%, we are at all-time lows. This is very interesting because just 2 years ago, during the pandemic, we were also at all-time highs. This chart shows consumer loans, which is primarily credit cards, and you can hopefully see that it's rising steadily. What this means is that people wiped out their personal savings with consumer spending, and they continue to spend with credit cards, which of course has to come to an end soon. What these two charts should show you is that consumers are going to be way more conservative in their spending in the future. The number 2 horse of the trifecta, inflation as measured by the CPI or Consumer Price Index, has been speeding up. So this chart represents the Consumer Price Index back from 2009. As you can see, it's continually, steadily gone up. And inflation, of course, has gotten out of control, as we all know, peaking at 9% June before last. And what this chart should show you is that after 11 rate increases, the Fed still has a problem and it has not won this game. On this chart, you're going to see the Bureau of Labor Statistics on the top, which is going to actually show the inflation in a bar chart. Far left represents 3.7% as of August. What you might not know is that inflation has increased the last 2 months. So the reason I included the press release below is if you'll see in the small print, it says the energy index rose over 5.6% in August as of all of the major energy components indexes increased. So even though this bar chart represents negative to bring down the average, the press release actually shows that it was a 5.6% increase. I don't know about you guys, but I just went to the pumps this week and the price per gallon was $6. Point here is it doesn't appear that shelter costs, food costs, and energy costs are going down anytime soon. Once again, the Fed is losing the battle. Horse number 3 are student loans. And as you guys might know, interest for federal student loans is accruing again, and payments will soon restart in October. Now, for many of you that don't have student loans, this might not seem like a big deal. So as of right now, there are 44 million Americans with student debt that are bracing for this payment shock. Many of them, of course, are filled with regret by multiple detailed studies, including this one from Bankrate. As of today, there is $1.75 trillion in student debt owed. This equates to an average of about $28,950 owed per borrower. What this really represents, however, is, of course, another payment and another debt that is now owed. And that's the most important thing to remember. That's why I started with consumer spending going down and inflation actually going up. And now this is actually just going to compound it. This, of course, is the 3rd horse of the trifecta. This is right on the precipice of a potential government shutdown, and we're right in the middle, in the beginning of a strike with all the auto workers. So what does this all mean? What it really means is that the economy is going to continue to contract this fall, and next year it's going to contract even more. As you can see from all of these studies, the gross domestic product growth could fall by 0.1% remaining year. 0.1% for 2023 and 0.3% in 2024, which could push us into a recession. So what does this trifecta mean, and what do these studies say? They all say the same thing. They say that there's a lot of headwinds, which is going to reduce consumer spending between now and the end of 2024 It's going to lower GDP and it's going to contract the economy, which is exactly what the Fed wants. And I can see these things showing up in my company. So as people pull back, they're going to continue to pay things like shelter, fuel, and food. Those are the basics. But all of the other items, they're going to start to pull back on. One thing is for sure, that there's a higher probability moving into next year that we could go into another recession.